Strategic Debt Restructuring in China, implementing a $300 billion financial recovery plan by Q4 2024. Overview. In response to escalating economic pressures, China has initiated a comprehensive strategic debt restructuring program aimed at implementing a financial recovery plan worth $300 billion by the fourth quarter of 2024. This initiative is particularly important given the significant corporate debt levels that have risen, alarmingly influenced by the lingering effects of the COVID-19 pandemic and ongoing trade tensions with Western nations. The plan emphasizes sustainable financial practices and efficient debt management, with advanced technologies such as artificial intelligence (AI) and blockchain being leveraged to enhance the effectiveness of the recovery efforts. Background and context. The economic landscape in China has been tumultuous in recent years, primarily due to 1. COVID-19 pandemic. The pandemic significantly disrupted economic activities, leading to higher corporate debts as companies struggled to maintain operations amidst lockdowns and reduced consumer demand. 2. Geopolitical tensions. Ongoing trade conflicts with Western countries, particularly the United States, have further strained economic conditions, leading to uncertainty in the marketplace and impacting investor confidence. 3. Corporate debt levels. As of mid-2023, corporate debt in China had reached unprecedented levels, raising concerns about defaults and economic stability. The government recognized the pressing need for a robust strategy to manage this rising tide of debt. The $300 billion Financial Recovery Plan. The recovery plan has been structured around several key objectives. 1. Debt restructuring. Aimed at reducing corporate debt burdens through negotiations with creditors, potential write-offs, and restructuring debt terms. Prioritization of distressed sectors such as real estate, manufacturing, and small and medium enterprises (SMEs). 2. Technology integration. AI applications, utilization of AI for predictive analytics and financial forecasting, allowing for early identification of potential defaults and the formulation of tailored repayment plans. Blockchain technology, implementation of blockchain solutions to enhance transaction security and transparency, facilitating real-time tracking of debt obligations and payments. 3. Investor confidence restoration. The plan aims to restore investor confidence by promoting transparency and efficiency in financial reporting and debt management. Use of technology to create a more robust financial ecosystem that can withstand future economic shocks. Timeline of events. 2020 to 2021, initial economic distress signals emerged due to the COVID-19 pandemic, leading to increased corporate debt levels. Late 2021, the Chinese government acknowledges the necessity for a comprehensive strategy to tackle the rising debt situation. Mid-2023, early proposals for the $300 billion recovery plan are drafted, focusing on the integration of AI and blockchain technologies. Q4 2024, targeted completion date for the full implementation of the financial recovery plan. Technology focus: AI and blockchain. Artificial intelligence (AI). Predictive analytics: AI algorithms will analyze vast datasets to forecast financial trends, helping organizations anticipate defaults and manage cash flows effectively. Automated debt management: AI systems will facilitate automated debt restructuring processes, analyzing individual corporate situations to suggest optimal repayment plans. Blockchain. Transaction transparency: blockchain technology will enable secure and transparent tracking of transactions, reducing the risk of fraud and enhancing trust among stakeholders. Smart contracts: the use of smart contracts can automate the execution of agreements, ensuring that all parties adhere to the terms of restructuring agreements. Global context. The Strategic Debt Restructuring Initiative is not just a national concern but is viewed as a vital step for China to stabilize its economy amid geopolitical tensions and a shifting global economic landscape. The integration of advanced technologies is seen as a pathway to regain investor confidence and adapt to modern financial practices. Differing perspectives. While there is consensus on the necessity of restructuring, viewpoints vary regarding potential impacts. Economic outlook: some analysts express optimism that the restructuring will lead to sustained economic growth and stability, while others remain skeptical about its long-term effectiveness. Technological impact: different sources emphasize the role of AI in improving decision-making and fraud detection versus the importance of blockchain in creating secure financial systems. Use cases and implementation strategies. 1. Predictive analytics: implementing AI-driven predictive models can help identify at-risk companies early, allowing for timely intervention and support. 2. Blockchain for financial transparency: establishing a blockchain-based system for tracking corporate debts can enhance stakeholder confidence and reduce compliance costs. 3. Automated debt management solutions: AI tools can streamline the debt restructuring process, ensuring that companies receive tailored assistance based on their financial conditions. Conclusion: the Strategic Debt Restructuring Plan in China, supported by innovative AI and blockchain technologies, represents a significant move towards enhancing financial stability and transparency. As the government works towards the ambitious goal of fully implementing the recovery plan by Q4 2024, the integration of these technologies will be crucial in navigating the complex economic landscape and addressing the challenges posed by high corporate debt levels. The success of this initiative will likely have far-reaching implications not only for China's economy but also for global financial markets. The Initiative for Strategic Debt Restructuring in China aims to implement a $300 billion financial recovery plan by Q4 2024, leveraging advanced AI and blockchain technologies to enhance efficiency and transparency in financial systems. This plan emerges in the context of rising economic pressures within China, exacerbated by COVID-19 impacts and trade tensions with Western nations. Counterintuitive information. 1. Debt recovery through technology. While many might assume that a financial recovery plan would rely primarily on traditional fiscal measures or government intervention, this initiative emphasizes leveraging advanced AI and blockchain technologies. This shift towards technology-driven solutions is counterintuitive in a context often dominated by manual processes and bureaucratic oversight in financial systems. 2. AI as a risk mitigation tool. Typically, AI is seen as a tool for efficiency and optimization in various sectors. However, in this context, it is being positioned as a predictive tool for identifying potential defaults before they occur. This proactive approach to risk management through AI is not the conventional use of the technology, which usually focuses on optimizing existing processes rather than predicting and preventing failures. 3. Blockchain for transparency in a controlled economy. The use of blockchain technology, which is often associated with decentralization and transparency in open markets, is being applied in a highly regulated and state-controlled economy like China. This seems contradictory, as blockchain's core principles challenge the very nature of centralized control typical of Chinese financial systems. 4. Investor confidence through technology. The narrative suggests that employing these advanced technologies will help regain investor confidence amidst geopolitical tensions and economic instability. This is a departure from traditional methods of building confidence, such as regulatory assurances or economic indicators, highlighting a fundamental shift in how trust is being cultivated in financial markets. 5. Implementation timeline amidst urgency. The ambitious goal to implement the recovery plan by Q4 2024 while addressing significant economic distress might suggest a rushed approach. However, the structured timeline highlights a strategic method of managing complex debt issues, contrasting with the expectation that urgent economic problems necessitate immediate, albeit less organized, solutions. 6. Corporate debt management versus state control. The focus on sustainable financial practices and efficient debt management may imply a departure from the traditional reliance on state intervention for debt resolution. This represents a counterintuitive move towards empowering corporations to manage their own debt more effectively rather than relying solely on government-led initiatives. 7. Long-term economic growth versus short-term solutions. the plan emphasizes sustainable financial practices, which is often not prioritized during economic crises. The focus on long-term structural changes rather than immediate fixes is counterintuitive, as many would expect quick fixes to be the priority in crisis management. 8. Use of predictive analytics in crisis. The application of predictive analytics during a financial recovery period may seem counterintuitive because organizations typically look backwards to understand crises rather than forward. This forward-looking approach signifies a shift in mindset towards understanding and anticipating future challenges. 9. Global context influence. While the plan is primarily focused on domestic recovery, the context of geopolitical tensions and the shifting global economic landscape suggests that external factors heavily influence internal economic strategies. This intertwining of global and local strategies presents a complex counterintuitive relationship where international dynamics significantly impact national recovery efforts. 10. AI and blockchain integration. The simultaneous integration of AI and blockchain solutions into the recovery strategy is surprising, as these technologies are often discussed separately. This holistic approach indicates a recognition of the interdependencies between data management, transaction security, and predictive capabilities, challenging the notion that technological solutions must be siloed. In conclusion, the Strategic Debt Restructuring Plan in China reflects a series of counterintuitive shifts in how economic recovery is approached, emphasizing technology, predictive analytics, and corporate empowerment amidst traditional economic paradigms. The report on strategic debt restructuring in China highlights an ambitious $300 billion financial recovery plan set to be implemented by Q4 2024. While many aspects of the report are likely to capture attention, there are several important details that may be overlooked, each carrying significant implications for China's economic future and the global financial landscape. 1. Integration of advanced AI and blockchain technologies. While the report mentions the utilization of AI and blockchain technologies, the depth of the implications of these technologies is often underappreciated. Significance. The application of AI and predictive analytics for financial forecasting can potentially transform how businesses assess their financial health and predict defaults. Traditional methods are often reactive. AI allows for proactive measures, enabling companies to address issues before they escalate. This shift could lead to a more resilient corporate sector, better prepared to handle economic shocks. Blockchain's role. Blockchain technologies integration for enhancing transaction security and transparency is another area that warrants deeper discussion. Limited transparency in financial transactions has historically led to issues like fraud and misreporting. By adopting blockchain, companies can ensure a higher degree of accountability and trust, potentially restoring investor confidence not just in China but in global markets that rely on Chinese investment. 2. Focus on sustainable financial practices. The report emphasizes the need for sustainable financial practices. Yet the specifics of how this will be achieved are less frequently discussed. Significance. Sustainable practices are crucial for long-term economic stability. The report suggests that restructuring efforts will not only relieve immediate debt pressures but also encourage companies to adopt practices that prevent future financial crises. For instance, companies may be incentivized to prioritize long-term growth over short-term gains, shifting investment strategies towards more sustainable and socially responsible projects. 3. Global context and geopolitical implications. The restructuring plan is framed within a broader global context which includes rising trade tensions and geopolitical challenges. Significance. The ramifications of China's economic health extend beyond its borders. A stabilized Chinese economy could lead to improved relations with trading partners, especially in the West, while a failure could exacerbate existing tensions. Observers often focus solely on domestic implications but overlook how this restructuring could influence global supply chains, trade balances, and international relations. 4. Historical context of debt levels. The report briefly mentions rising corporate debt levels but does not delve deeply into the historical context of these trends. Significance: understanding the historical trajectory of corporate debt in China can provide insights into the systemic issues that have led to the current crisis. High levels of corporate debt have been a long-standing problem worsened by the COVID-19 pandemic and sluggish growth in certain sectors. This context is critical for stakeholders to understand the urgency and the potential consequences of inaction. 5. Use cases for AI and blockchain beyond financial management. The report lists potential use cases for AI and blockchain technologies but may not comprehensively cover their broader applications. Significance: the integration of these technologies can extend beyond debt management to various sectors including healthcare, manufacturing, and logistics. For instance, using AI for optimizing supply chains can significantly reduce operational costs and improve efficiency. Blockchain could enhance traceability in supply chains, promoting greater accountability and reducing fraud. 6. Implementation timeline and urgency. The timeline of events leading to the Q4 2024 goal is laid out, but the urgency of these timelines may not be fully appreciated by stakeholders. Significance: the specific timeline indicates a strategic urgency that reflects the increasing pressures on China's economy. Stakeholders should recognize that failing to meet these deadlines could have cascading effects on investor confidence and economic stability. Delays could lead to worsening debt situations and possibly trigger broader economic repercussions, including social unrest. 7. Potential for geoeconomic realignment. The report hints at the potential for a geoeconomic realignment as a result of the restructuring. Significance: this aspect is critical as it suggests that the restructuring could lead to a shift in global economic power dynamics. Countries that benefit from improved relations with China could see enhanced trade opportunities, while those that do not adapt may find themselves at a disadvantage. This could reshape alliances and affect global economic policies. 8. Stakeholder engagement and communication challenges. The report does not sufficiently address how the Chinese government plans to engage with various stakeholders, including businesses, investors, and the international community. Significance: effective communication is essential for the success of any restructuring plan. If stakeholders are not adequately informed or engaged, it could lead to resistance or lack of trust, undermining the recovery efforts. A well-structured communication strategy could facilitate smoother transitions and foster collaboration among all parties involved. 9. Long-term structural reforms. Beyond immediate debt relief, the report alludes to the need for long-term structural reforms but does not elaborate on what these might entail. Significance: addressing underlying structural issues such as state-owned enterprises' inefficiencies, regulatory barriers, and market access will be crucial for sustainable recovery. Stakeholders should consider how these reforms will be prioritized and implemented, as they will ultimately determine the effectiveness of the recovery plan. Conclusion: the Strategic Debt Restructuring Initiative in China represents a pivotal moment for the country's economy with implications that extend globally. While various aspects of the recovery plan are discussed, it is essential for stakeholders to recognize the deeper significance of AI and blockchain integration, the historical context of debt levels, the urgency of the timeline, and the broader geopolitical implications. By focusing on these often overlooked elements, stakeholders can better prepare for the shifts in the economic landscape that are likely to emerge in the wake of this ambitious restructuring effort. 1. Financial Recovery Plan. The strategic debt restructuring in China represents a proactive approach to address the escalating corporate debt levels, which have become a significant concern for the economy. The $300 billion financial recovery plan is not just a financial maneuver but also a commitment to sustainable financial practices that aim to stabilize the economy in the wake of increased pressures from the COVID-19 pandemic and geopolitical tensions. Analyzing the sustainability aspects of this plan could provide insights into its long-term viability. 2. Use of advanced technologies. The integration of AI and blockchain technologies is a cornerstone of this restructuring initiative. AI will facilitate predictive analytics for financial forecasting and risk management, while blockchain will enhance transaction security and transparency. A deeper discussion could focus on the specific applications of these technologies in debt restructuring and how they could revolutionize financial systems, potentially creating a model for other countries facing similar challenges. 3. Global economic context. The restructuring initiative is positioned within a broader global context where countries are increasingly facing economic instability due to external pressures. This strategic move by China is seen as an effort to regain investor confidence amidst rising trade tensions and economic distress. A comprehensive analysis could explore how this plan not only impacts China's economy but also its relationship with global investors and markets, and how it might influence other nations' approaches to economic recovery. 4. Timeline of implementation. The timeline outlined for the implementation of the Financial Recovery Plan culminating in Q4 2024 highlights the urgency of the situation. This timeline also serves as a framework for evaluating the plan's success and adaptability in a rapidly changing economic environment. A discussion around the milestones and challenges anticipated along this timeline could yield valuable lessons for policymakers in China and globally. These points encapsulate the key themes of the strategic debt restructuring in China, highlighting areas for in-depth analysis and discussion that could significantly inform stakeholders and policymakers. Here are 3 famous historical cases of strategic debt restructuring that resonate with the context of China's current financial recovery plan involving advanced technologies like AI and blockchain. 1. Argentina's sovereign debt restructuring 2001 to 2005. In the early 2000s, Argentina faced one of the largest sovereign debt crises in history, leading to the country defaulting on about $95 billion in debt in December 2001. The restructuring process began in 2005 when the government offered to exchange old bonds for new ones at a reduced value, which involved significant negotiations with creditors. This restructuring was notable for its complexity and the involvement of various stakeholders, including private creditors, international financial institutions, and the International Monetary Fund (IMF). The use of innovative bond structures and the eventual involvement of the Paris Club for further negotiations helped stabilize Argentina's economy, albeit with mixed results in the long term. This case highlights the importance of negotiation, stakeholder management, and the potential use of new financial instruments in debt restructuring, similar to how China might use AI and blockchain for efficiency in its current context. 2. Greece's debt restructuring 2010 to 2018. Greece's sovereign debt crisis began in 2009, leading to the need for multiple bailouts from the European Union and the International Monetary Fund (IMF). The first major restructuring occurred in 2012, where Greece implemented the largest sovereign debt restructuring in history, involving a write-down of approximately €100 billion in debt held by private creditors. This process included the use of collective action clauses to facilitate the participation of all bondholders and required extensive negotiations with various international stakeholders. The restructuring aimed to restore sustainability to Greece's debt profile while implementing extensive economic reforms, public sector cuts, and austerity measures. The Greek case provides insights into the challenges and strategies involved in dealing with substantial debt relief and the complexities of international financial negotiations akin to the current challenges faced by China amidst economic pressures. 3. Puerto Rico's debt restructuring 2016-present. Puerto Rico began to face severe fiscal challenges with a growing debt burden, leading to a historic default in 2016 on approximately $70 billion in debt. This prompted the introduction of the Puerto Rico Oversight Management and Economic Stability Act (PROMESA), which established a financial oversight board to manage the territory's finances and facilitate a restructuring process. The restructuring involved negotiations with bondholders, the implementation of fiscal control measures, and efforts to stabilize the economy while ensuring essential services were maintained. The restructuring process has been prolonged and has faced numerous legal and political challenges, underscoring the complexities of managing public debt in a politically sensitive environment. This case illustrates the intersection of governance, economic policy, and stakeholder engagement, reflecting the multifaceted approach that China may need to take in its own financial recovery and restructuring efforts. These historical cases provide valuable lessons and parallels for China as it embarks on its strategic debt restructuring initiative, particularly in the context of utilizing advanced technologies to enhance the process's efficiency and transparency. Future outlook: strategic debt restructuring in China through AI and blockchain solutions. Introduction. China's initiative for strategic debt restructuring, with a target of implementing a $300 billion financial recovery plan by Q4 2024, aims to address the escalating corporate debt crisis exacerbated by economic pressures stemming from the COVID-19 pandemic and ongoing geopolitical tensions. The integration of advanced artificial intelligence (AI) and blockchain technologies is poised to revolutionize the approach to financial recovery, enhancing efficiency, transparency, and investor confidence. This analysis offers predictions regarding the future implications of these initiatives. 1. Enhanced predictive analytics and risk management. By leveraging AI, China will likely witness a significant improvement in predictive analytics within the financial sector. Advanced algorithms will facilitate the analysis of vast datasets to identify potential defaults and financial risks early. This proactive approach will enable financial institutions to implement preventive measures, swiftly reducing the likelihood of widespread corporate failures. As businesses adopt AI-driven risk management strategies, the overall stability of the financial system is expected to improve, fostering a more resilient economic environment. 2. Blockchain for transparency and trust. The integration of blockchain technology in financial transactions and debt management systems is set to transform the transparency and accountability of corporate financing. Smart contracts will automate and secure loan agreements, ensuring that all parties adhere to the terms without the need for intermediaries. As a result, the Chinese financial ecosystem will likely experience a reduction in fraud and corruption, enhancing trust among investors and stakeholders. This newfound confidence may lead to increased foreign investments, further stabilizing the economy. 3. Streamlined debt restructuring processes. AI-driven tools can automate and optimize the debt restructuring process, allowing for tailored repayment plans based on individual corporate needs. This customization will likely result in higher recovery rates for creditors and reduced financial strain on struggling companies. As the restructuring framework becomes more efficient, the overall time taken to resolve debt issues is expected to decrease, promoting quicker recovery and renewal of business operations. 4. Increased government oversight and regulatory frameworks. As the Chinese government pushes forward with these initiatives, it is expected to establish more rigorous regulatory frameworks to manage the integration of AI and blockchain in the financial sector. This heightened oversight will ensure compliance with international standards and foster a stable environment for financial innovation. Additionally, it may lead to the creation of specialized regulatory bodies dedicated to monitoring AI and blockchain applications, ensuring ethical practices and consumer protection. 5. Global economic implications. The success of China's strategic debt restructuring, supported by AI and blockchain, may set a precedent for other countries facing similar economic challenges. By demonstrating the effectiveness of these technologies in mitigating financial crises, China could influence global economic policy and encourage the adoption of AI and blockchain solutions worldwide. This shift may lead to the emergence of new financial models that prioritize transparency, efficiency, and sustainability. 6. Evolution of the corporate landscape. As companies adapt to the new financial landscape, those that embrace AI and blockchain technologies are likely to gain a competitive edge. Businesses that integrate these innovations into their operations can optimize processes, reduce costs, and enhance customer experiences. Consequently, a wave of digital transformation will likely sweep across industries, reshaping the corporate landscape and potentially displacing companies that resist change. 7. Potential challenges and risks. While the transition to AI and blockchain-driven financial solutions holds great promise, it is not without challenges. Cybersecurity threats and potential misuse of AI technologies pose significant risks that could undermine the benefits of these innovations. Additionally, the rapid pace of technological advancement may outstrip regulatory efforts, leading to gaps in oversight and potential exploitation. Addressing these challenges will require ongoing collaboration between governments, businesses, and technology providers. 8. Societal impact and workforce transformation. The implementation of AI and blockchain in debt restructuring will inevitably change the workforce landscape. While some jobs may be displaced due to automation, new roles focused on AI management, blockchain development, and regulatory compliance are expected to emerge. Upskilling and reskilling initiatives will be crucial to prepare the workforce for these transformations, ensuring that employees can adapt to the evolving job market. Conclusion. The Strategic Debt Restructuring Initiative in China, underpinned by AI and blockchain technologies, is poised to reshape the financial landscape and drive economic recovery. As predictive analytics enhance risk management, blockchain fosters transparency, and streamlined processes emerge, the potential benefits are substantial. However, navigating the associated challenges will require collaborative efforts from all stakeholders. The global implications of this initiative could redefine financial practices worldwide, influencing how nations address economic crises in the future. As we move closer to Q4 2020, the success of this initiative will be closely monitored, serving as a critical case study for similar endeavors globally.